Welcome back to Alpha Recap, your post-market wrap of the biggest moves and the stories behind them. Markets were closed for the day, and we're unpacking what mattered in the last 24 hours. As always, if you have questions, you can reach us at stockalpha.ai.
Thanks for having me. Lots to dig into. Earnings beats, a federal cloud win, and a surprising batch of 8K filings. It felt like 3 different markets in one day.
Totally. Let's start with the headlines. There were 3 threads that dominated our coverage: company earnings and monetization beats, Oracle winning a federal cloud contract, and, this was interesting, a cluster of Form 8K filings that could foreshadow volatility. Which one do you want to hit first?
Let's go earnings, then zoom to Oracle, and finish with the filing mosaic. Works for me.
Starting with Robinhood. This was a clean beat, and it was more about quality of revenue than raw volume. They reported fourth quarter revenue of about $1.3 billion, up about 27% year over year.
Right, and the kicker there was gold subscriptions, which grew by about 109%. That's the kind of recurring revenue lift that changes how investors think about a fintech built on trading activity.
So, what really stands out here is the shift from volatile crypto and trading volumes toward predictable subscription and payment streams. I mean, that's a narrative inflection.
Yeah, that tracks. Subscriptions and payment facilitation are higher margin and less cyclical than pure transaction fees. For Robinhood, that means better revenue quality even if trading volumes wobble. Next up, AppLovin. They beat estimates, and Jefferies kept a buy and held on to an $860 price target. Interesting, because the stock had already fallen about 37%.
Hold on. Say that again? $860 after a 37% drop? That's a big contrast.
Exactly. The debate is classic. Momentum investors see the beat as confirmation of improved ad monetization. Skeptics ask whether one quarter is enough to justify the valuation, especially in ad-sensitive names.
Honestly, I was a bit surprised by this one.
Yeah, same. It's an attractive volatility play if you believe ad demand will normalize or improve, but you need follow-through and guidance.
Quick reactions? Interesting call. Risky play.
Right.
Now, the Oracle story. This was more strategic than strictly financial in the near term. Oracle won a federal cloud contract with the Centers for Medicare and Medicaid Services on February 11th. And analysts framed it as a credibility inflection for the federal pipeline.
Government contracts like CMS aren't huge revenue windfalls immediately. They tend to be smaller compared with hyperscaler deals. But their signaling value is huge. They show you can meet rigorous FedRAMP security, compliance, and uptime requirements.
Which, in plain English, means that other agencies or regulated industries may be more willing to consider Oracle. It raises switching costs and suggests more durable recurring revenue down the road.
Exactly. It's a credibility milestone, not a singular turning point. Supporters will point to the referenceability. Cautious investors will say it's one important tile in a very big mosaic.
Now, at the other end of the ledger was Coinbase. They posted a fourth quarter earnings per share loss of $2.49 versus an expected profit of 55 cents. Revenue was down about 22% year over year.
That was the headline. But analysts did praise early signs of revenue diversification away from high beta trading fees into custody, subscription services, and institutional products.
So the market was torn. You had long-term buyers welcoming the pivot and short-term traders focusing on the profitability miss. Pretty binary reaction depending on your time horizon.
Right, and that tension is real. The strategic shift is sensible, but you can't paper over a 22% top-line decline and a material EPS miss. Execution pacing will determine whether the transition earns a re-rating.
Short segment, rough quarter. Tough headline. Now this was the wild card. A cluster of Form 8K filings from a range of companies. Bluebird, Churchill Capital Corp X, Global Business Travel Group, Fiscal Note, News Corp, among others. They covered material definitive agreements, potential change in control language, Regulation FD disclosures, a real filing storm.
These 8Ks themselves didn't move markets massively, but they're important early warning signals. They increase the odds of asset sales, financings, leadership changes, events that can drive outsized short-term moves.
Investors should parse exhibits, not headlines. The terms, timelines, and any change in control clauses were the real thing to watch.
Absolutely. Event-driven traders will want to dig into financing terms or potential dilution. For long holders, governance signals can indicate forthcoming strategy shifts.
Okay, let's step back and pull out the cross-cutting themes we were tracking across these stories.
First, monetization versus raw activity. Companies that were converting user behavior into recurring or higher margin revenue were getting rewarded. Robinhood was the clearest example.
Second theme, narrative inflection points matter more than binary beats. Oracle's CMS award boosted credibility, which is often more valuable than a single contract's check.
Third, diversification is being rewarded, but not uniformly. Coinbase showed that investors will applaud the pivot on principle, yet punish near-term profitability misses.
And fourth, the 8Ks raised governance and event risk. Not all filings become material, but they raise the probability of consequential actions that can create volatility.
So, what should different investor types have done after the close? Let's run through the playbook.
Sure. Growth investors. Focus on conviction names with improving monetization. Robinhood and AppLovin's beat created tactical long ideas. But watch guidance and be ready to trim if follow-through falters.
Value and long-term investors. Oracle's federal win strengthens the enterprise cloud thesis, a potential entry for those who value recurring contract income. Also, Coca-Cola Euro-Pacific showed margin improvement that appeals to defensive allocators.
Event-driven and activist investors. The 8K wave is your hunting ground. But parse exhibits carefully. Financing terms, timelines, and change in control language matter.
Risk-on traders and speculators. AppLovin offered volatility plays after a large prior drawdown, but it's highly sensitive to ad spend trends. Coinbase remained a high headline risk name given regulatory and crypto cycle risk.
Income and defensive allocators. Coca-Cola Euro-Pacific again. Steady top line and improving margins are attractive for a ballast position.
Let's talk tactical signals to watch next week. First, guidance updates from AppLovin and Robinhood were the obvious near-term catalysts.
Second, any follow-on federal wins or renewals for Oracle. A pattern of government and regulated industry customers would elevate conviction in their cloud story.
Third, the detailed exhibits in those 8Ks, especially for Churchill Capital Corp X and Bluebird. The financing terms and potential change in control clauses will be the tell.
And fourth, for Coinbase. Watch institutional revenue mix, custody inflows, and any margin improvements that could move them back toward profitability.
Strategically, we recommended being selective, not broad. Prefer positions that combine improving monetization with visible earnings conversion, and layer in optionality via stage sizing on high-conviction names.
Use 8Ks as catalysts. They're signposts more than headlines. Read exhibits. Don't skim summaries.
Hedge macro and regulatory risk for fintech and crypto names. Those risks can rapidly reprice multiples.
And keep a defensive ballast. Allocating to cash-generative, margin-improving companies can protect portfolios if sentiment cools.
Quick reactions, selective re-rating, watch guidance, read the filings. The bottom line was nuanced. It wasn't a broad risk-on rally. Instead, we saw selective re-ratings where companies improved revenue quality or secured credibility-enhancing contracts.
Oracle's CMS deal and Robinhood's subscription momentum were durable positives. AppLovin was attractive to momentum buyers, but required confirmation. Coinbase highlighted the tension between strategic pivoting and near-term profitability misses.
And the 8K wave was a reminder. Governance and capital structure items can create outsized short-term moves. Discipline and due diligence remain essential.
Final quick takeaways. 1. Prefer companies showing durable monetization. 2. Treat government contracts as credibility catalysts, not magic bullets. 3. Read the exhibits and filings. That's where the real detail lives.
4. For traders, size staggered positions around beats and guidance, and use hedges for regulatory or macro risk. And 5. Keep defensive ballast for volatility.
Thanks, Drew. Any last thought before we sign off?
Just this, be patient with pivots like Coinbase's. Strategy sounds right, but execution matters. Watch the metrics, not the slogans.
Great, that's a wrap for today. If you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai.